Well, good afternoon, everybody, and welcome to our second Friday afternoon session of the COVID cancellation conference, also known as Successful Investing One. We do consider this to be an inaugural main event. We hope to put these on in some form of frequency based on demand and topics. You just heard us talking about an FDA pipeline discussion sometime in the near future. That sort of thing happens around here all the time. My name is Mark Robertson. I'm founder and managing partner of Manifest Investing, and we are blessed to be joined here by Hugh McManus from his sunny California abode. Say hello, Hugh.
Hello, everyone. Just joking online that it's freezing here. It's 74, but I like that kind of weather.
It's freezing at 74?
No, I'm not kidding.
Whoa. Well, we have entitled this series of sessions Investing, subtitled Before, During, and After a Storm. We've certainly been through a storm here in the last couple of months, and the picture is following a storm on a lake in northern Michigan. And what we are here to share, we used to talk about the next bear market as a hypothetical or an inevitable, and sure enough, we're probably in the middle of a correction, a recession, a bear market, or something of that nature at this point in time. So we thought we would take this time to reflect and perhaps remind a little bit of the type of stuff that really matters in the realm of investing. So again, we need to go through some of the legal beagle paperwork. No investment recommendation is intended. We won't talk so much about specific stocks in this particular presentation, but everything we do is to basically reinforce a philosophy or a method as promulgated by the Modern Investment Club movement and demonstrated by NAIC, Better Investing, and or Manifest Investing. The views are our own. We will be sharing some opinions. If we talk about a company that we own, we try to make that clear. If you'd like to be added to an email reminder list, send an email to nkavula1@comcast.net, and Natalie would be happy to give you very timely reminders. She will not inundate you with emails, but she'll simply remind you whenever we get together to do something like this. If you would like to request a copy of the slides, or if you have follow-up questions, my email address is markr@manifestinvesting.com. All right, this is the third of our 5 sessions, Bear Market Lessons. And we certainly have had a number of lessons here in the last month or so. And we'll be talking a little bit about that turbulence. But I thought this quote, by the way, this was on the worst day last month that you could imagine. I don't remember how many % down we were, but I call Hugh on the phone, and this is how he answers the phone. I mean, against a backdrop of people on CNBC explaining to me that the world was going to end, later that day.
Yeah.
This is how you greeted me. So thank you, Hugh.
Yeah. In fact, this is a statement of optimism. I know it doesn't read like that, but it really is. The last time this happened, I mean, it's granted 2008, but the last time before that, you have to go all the way back to the 1930s. So for many people, they just never lived in their investing lives through an event where all of a sudden, so many quality companies went on sale altogether.
Oh yeah, it's furious. I mean, who knows? We're still in the middle of it all, but I have found it greatly frustrating that opportunities, I'll talk more about this later, opportunities can be fleeting in this market.
Yes.
It's just incredible. Usually you got some time to think about it. So yeah, we're in one of those.
The other thing I was going to say about CNBC, if you view that as, because I enjoy it, right? But I know it for what it is. It is the financial Playboy channel. And if you realize that, you don't take it too seriously. It's there to excite people.
Oh, it's hard to top that. Oh well. All right. So here's some of the stuff we thought we would talk about. Hugh and I have done a version of this presentation a number of times. It's been on the agenda for the National Convention and a number of regional conferences, but for whatever reason we failed to connect up. I look forward to doing this. Just this notion of perspective and context. And another one of Hugh's favorite quotes, patience, being wisdom. We'll talk a little bit about Nicholson's perspective. You heard Hugh mention it, the bear markets of the last 50 or 60 years and what you could learn. We'll talk about this notion of a triple play, probably a type of screen that we'll demonstrate during tomorrow afternoon's late session. And then words from the Schaumburg National Convention that will live forever in infamy. I want to buy bank. And everybody here knows who said it. It was Hugh standing at the podium. And I kid you not, there were people nauseated by that thought in the audience. So we'll ask Hugh to explain what he was thinking. Then we'll take a very powerful moment and talk about our favorite stocks from March 2009 and how they did over the next 10 years, because close your eyes, think back to how ugly it was in March 2009. You know, how hard it was to go shopping for a stock. And then we'll talk about, well, what actually happened. And of course, just I think you and I both want to nudge everybody into respecting the notion of this long-term vision going forward. Any thoughts on any of that, Hugh?
No, it's a nice plan for the evening, for the afternoon. I love the quote. It's not my quote. I'm recycling all of other people's wisdom here, but benefiting from it greatly. But the statement that I really like about patience is that it's wisdom in disguise. I mean, the correct form of laziness appropriately applied in the stock market is financially very rewarding. Oftentimes activity isn't. Complete opposite of a gym.
Absolutely.
You want to build financial muscles, get on the couch.
I'll have to remember that laziness quote from my wife's honey-do list. All right. And then kind of to kick things off, he actually did this again. He didn't do it, I don't believe, at least in my opinion, didn't do it as well as he did it 10 years ago. But everybody knows Warren. We're on a first name basis with Warren. And this is exactly what he had to say back as we were entering into the teeth of that very nasty, turbulent market moment a little over 10 years ago. And, you know, just think about the wisdom here. We don't know. We don't know what's going to happen in the next 6 to 12 months. I can show you with a stock selection guide that it doesn't matter. As long as you're picking quality companies that will still be here in 5 to 10 years, it just doesn't matter. And the American economy, the innovation, the entrepreneurial spirit has never wavered. And I think that's kind of what Buffett said just a Saturday ago. Any thoughts on that, Hugh?
No, it's a great quote. Phenomenal quote. It reminds me of the fact that even in the darkest days of hyperinflation in Germany in the 20s and 30s, when everything looked like it was going to be a complete disaster, well, it ended up actually being a complete disaster, but financially a complete disaster. People's savings were wiped out. The only people who really were able to see through that and were able to hold on to their nest egg were people who had invested in quality companies in the market, because they ended up tracking inflation. And yes, it was unpleasant for many years, but they eventually all bounced back. And then, of course, politics went south. That's a different story. But in terms of finance, sticking to the market was the key.
Yeah, and I think that it's important to recognize that there are extraordinary opportunities out there, and it's just something to be always aware of and be ready to react to. All right, Hugh, you love to share Rukeyser stuff. Tell us about this one.
I found this on YouTube a number of years ago. YouTube is just a great resource. And I used to love watching Wall Street Week with Rukeyser on PBS when the show was on. But there are some classic examples of that still today on YouTube. And this was one from 1987. He did a show the Friday before the great crash on Monday. Was it Monday the 20-something, probably the 26th.
Yeah, it was right.
But
right
he did a show.
Window.
He did a show on before that, and where he had one of the panelists. I can't remember the guy's name, but he was a household name of the day, who said something bad was going to happen and prophesied to some extent that it was going to be a big sell-off the following Monday/Tuesday. And then he did a show the week after where he had investing luminaries come on And he basically communicated the message that your family still loves you, the country's still going, post office is still working, everything is fine. It's just the stock market, which is a pricing mechanism, has gone bananas. And it's for some reason, it's wrapped its way into people's feelings and expectations, and they're all tense and nervous too. But everything in the long term the boat will right itself. But it was a horrible time. I mean, the stock market had its worst decline, I think, ever. I think even it beat some of the percentage declines that occurred at the start of the Great Depression.
I think it was like 27% in one day. Somebody in the audience probably remember, but I know it was more than 20% in one day.
Yeah.
So, and I will make a point for the millennials. We got a few millennials in the audience, or people that weren't as cognizant of the stock market back in 1987. This was a show on PBS, Public Broadcasting System, that came on, I think it was 7 or 8 o'clock on Friday nights. And it was done. It was just shot and just like from Joe Biden's basement. I mean, from Lou's living room, and all these people would come and sit and talk about stocks and markets in general. And it was literally just a half hour long with some stale jokes and really funky graphics. And it's just a real treat to be able to go back and watch some of this stuff. And Lou had a real calming charisma about him, and it was really fascinating to watch him deal with some of the panicking rhinos of the moment.
Yes. Actually, I have one line that he came out with once, which, because he had a great sense of humor, but he had a panelist on discussing a government policy, and the panelist was just lamenting this policy, describing what a disaster it would be, and finished the comment by saying, and it will put business in jeopardy. And Lou's comment, which was a great, it shocked me at the time, but God, it makes so much sense. It'll put business in jeopardy. And Lou said, is that not what business should be? Which is true. There's no free lunch. You have to fight for every dollar, you know?
I
if
can
it were
also,
easy, everyone would be doing it.
I can
Mark,
also,
I'm going to interrupt for a second.
Yeah,
our audience is really, really smart, and they're identifying the other gentleman as Lou Rukeyser's father.
That's right. Oh, yeah, I've forgotten that. You're right.
Awesome.
Yeah.
Awesome. Yeah, the one that I remember was an analyst was on predicting all kinds of gloom and doom, and the young analyst made some comment about a company being unsustainable. And Lou, very, very diplomatically, basically stopped the young analyst in their tracks and said, explain this unsustainable to me. What does that mean? What do you see? And the poor young analyst could not do it. I mean, it had to do with some food company or something. And Lou was like, you know, the thing that you were describing to me, I can't even imagine. And, you know, you're basically not building a picture that I can even see, this unsustainable. Yeah. What does that mean? And what does it mean to me as an investor? And it was really kind of a cool moment. He would do that from time to time. All right. And then fast forward to a few years later, this was actually in the teeth of the 2008 situation. Just to set the stage for you guys, Hugh would call me on the phone, usually from Switzerland or all the places that he gets around to, and he was very familiar with world economies and stuff going on. And we talked through all kinds of stuff with respect to the financial crisis and the stuff that was happening in the mortgage markets. I wish I had taped him, because I'm literally pacing around on my deck, hearing this stuff firsthand that he sees from his world travels. And wow, what a moment in time it was. Yeah,
incredible, really. But I mean, it's obvious in hindsight. The irony of a bubble is often pointed out is that you can't see it when it's there. You can see a bubble when it disappears. It's the complete opposite of a real bubble. But this one was somewhat clearer to me. I remember when I tried to buy a house back in late 2007. It was everyone I heard was getting all these loans, and no one was checking the backgrounds. But I went to banks, and they wanted 20% down, and they wanted X, Y, and Z. All ducks had to be in a row. Even Washington Mutual, which is my friendly bank, seemed to be the toughest. So I was wondering, who are these people that are getting all these no down payment loans at great interest rates and so forth and so on? And when you actually did the calculation, when I did the calculation of buying the house I was living in, because I was renting it and I was thinking of buying it, the monthly payment that I would have to make to own the house was twice what I was to rent it. That made no sense. So I checked around. I thought my landlord was giving me a good deal, but when I checked around, he wasn't. It was far more expensive to own, and far more, by a factor of 2 sometimes, to own a house than to buy it. That clearly was a signal that was the equivalent of a PE for a house was too high. And something has to give, you know?
Well, I can remember the days vividly, and I had never heard of a credit default swap. And this is actually a post from the Manifest Investing Forum back in September 2008, where he wanted to talk about this stuff. I will share with the audience that a few months later, I believe it was the following summer, I happened to be in Chicago at the Morningstar conference, sitting in their green room with Jack Bogle. And Jack Bogle, the Vanguard founder, very famous investor who passed away last year, Mr. Bogle explained to me that he didn't know. He had never heard of a credit default swap until all this stuff hit the fan. So that gave me a little bit of relief that, this wasn't something that was on the tip of everybody's tongue at the time. And it was pretty comforting. By the way, he did pretty much storm into the offices at Vanguard and threatened anybody within an inch of their life if they were involved in any of this kind of stuff at the time. So that just shows you how intense it was back in that time frame.
Yeah, it was insane, really.
And I do remember, Hugh, that you shared the book by Charles Morris back then. Pretty good guide to a lot of the madness that was going on.
Yeah, it really was. That's where I learned about all these credit default swaps and synthetic CDOs and the works. And this book was published about a year before the fan got occluded. But it was the $1 trillion meltdown, of course, in its first run. I couldn't get anyone. You bought the book. You were interested in it, but no one else seemed to want to read it until actually it was, everything had happened, and then it was more of a history lesson.
Yeah,
but it was an excellent book.
Only other person I know of, Ralph Seeger, went out and got a copy of it after you recommended it. And and Bailout Nation, pretty good summary too by Barry Ritholtz back in that same time frame. But yeah, wild stuff going on. All right,
yeah.
Then again, closing out with the Rukeyser part, on that show the week after the one that we just had up there, I would consider this a must-watch. Sir John Templeton, being on the screen, and you guys can all do your own reading here. It's just fascinating to see how a true long-term investor thinks about this stuff and the type of perspective that they have. And I can't remember the exact 4 people on the panel. Should have looked it up before we got here, Hugh, but he had 3 or 4 giants of investing.
Yeah, he did.
In his living room the next week.
Yes. I don't know if Peter Lynch was on that week, but
he was definitely around that time frame, I remember. But yeah, I mean, I think Templeton's rule number 10, don't panic. Take a deep breath and figure out what can you do. And again, much like Hugh's opening quote, we're in a bear market. Let's find some stocks to buy. And it's really fascinating what I've been able to witness over the last several decades with our community of investors and how they really do think this way. It's a wonderful thing to witness in action. So again, you millennials, grab that link at the bottom, take a look, and you talk about perspective, and wow.
Yeah, and yes, I think it's a better idea to look at the link, because that way you'll learn how to spell his last name, and then you can do a search for other examples of those Rukeyser. So his last name is a doozy to spell, at least the first time.
Yep. All right, in the middle of all
he was
this,
definitely a giant.
Yep. In the middle of all this, Hugh already made mention of this in the opening comments. George Nicholson, one of the founders, if not the founder, of the National Association of Investors, we've spent considerable time looking at how he looked at these financial moments of trial and tribulation and turbulence. And one of the neat periods in time was back in the mid 1970s when we had a very nasty stock market, another situation with the energy patch, the oil patch, and the disruption in the mid 1970s. I can remember you could only gas up on odd and even numbered days based on your license plate. It was a really nasty moment back in the mid 1970s, and the stock market was treated pretty badly back then. And Mr. Nicholson went back and looked at, what happened back in 1938 and all that kind of stuff. Some very powerful perspective that we have shared from time to time. You remember waiting in line for gassing up, Hugh?
Well, yeah, I was in Ireland at the time. It was kind of worse there, We actually had to go to the post office to get ration coupons. The first time that they started to do that since the Second World War. And I remember my father had a Ford Granada, which had a big engine for cars in Ireland. And so they sent me home to double check that it was the right car, because I didn't think a car had that big. Any car in Ireland had an engine that size. Because you got more of an allowance if you had a very large car.
So again, one of the powerful reminders from this time frame, back in 2008, you can see every one of those blocks on the histogram up at the top represents a 10-year period in the stock market. And look at the number of times that it's been less than 4%. And obviously 1975, that period of time and the turbulence back in 75 was basically equaled or exceeded in 2008. And we ended up actually going back and looking at the 1938 time frame to see what kind of lessons we could learn. One of the lessons we took away from that time frame, Nicholson put out a series of articles talking about this notion of a triple play, and he centered it on Coca-Cola back in that time frame. And the Nicholson triple play is just simply what you see on the screen. 3 conditions. They don't happen all that frequently. They're better during bear and nasty markets. But what you're looking for is a stock where the stock price has been crushed and has been kicked around. We talked about some of that last night in the stock panel. The second thing is you want to have a company that's going to be around, that has the possibility for greater profits in the future. And third, last but not least, you want to compare where you're at with the current PE ratio to what is the PE ratio 5 years out, and look for the opportunity for PE expansion. So those 3 elements are something that, again, when you're in the middle of times like this, times like we had back in 2008, 2009, you really want to be looking for these type of companies. And lo and behold, last night, Ken presented General Dynamics, and simply because Ken Kavula does triple plays in his sleep, I figured this one probably qualified. And you can see upper left, it had a double-digit return. That's before the stock price went from 175 down to 120, which is where it currently is. So the stock price has been hammered. It's dropped off quite a bit from this value line, which is now 2.5 months old. The PE ratio at that time was 14. It's now probably closer to 11. The analysts are looking at a future PE of this company of 15.5. So point number 2 of the triple play, we've got a crushed stock price, an opportunity for PE expansion. And the third element is an opportunity for improving profitability. Looking down here at the net profit margin, the current is 8.9, approximately 9%. They're looking for it to go as high as 10%. So again, that's a 10% gain from 9% to 10% in profitability. So again, Ken just does this in his sleep, presents a company that has the 3 components of the Nicholson triple play. Back in that 2008-2009 timeframe, there were a number of conferences we attended where we demonstrated this, and companies like Mettler Toledo, companies like that really performed extremely well over the next 5 to 10 years. So that's a lot of fun. All right, Hugh, let's talk about buying a bank. This was the
Oh
slide.
yeah.
This was the slide for Bank of. I'm not kidding, people. We're standing in front of an audience, a standing room only audience of people in a ballroom in Chicago, Schaumburg specifically, and wall to wall people. And he says, "I want to buy a bank." We had people nearly losing consciousness.
Mhm.
What were you thinking?
Well, that conference actually was 2008, wasn't it?
I believe so.
Yeah. So it was before the banks had started to decline, and there were all kinds of. What I was thinking was the following: there was $1 trillion missing. I couldn't figure out in the economy where $1 trillion had gone. Because people were busy buying houses, right? And they were paying too much for them. And as I said before, I didn't want to pay for a house double what I could pay to rent it, because I prefer to put that difference into the stock market. And so something had to give. And I read from that book that you pointed out, which was called The $1 Trillion Meltdown at the time, that all of these fancy financial vehicles that they had devised to essentially eliminate, if you will, risk, but they really had piled it up somewhere else. And I think everyone, if you started to scratch the surface on that, knew it had to give. So I wanted to buy a bank. I'd never owned a bank. I was always jealous of the late, great Joe Smith from New Jersey, who was buying banks all the time. And I was determined to buy one, but I didn't want to pay the prices that they were offering right then to own shares in a WAMU or a Bank of America or one of the big guys. And I figured the banks that are writing mortgages are going to get hurt by this decline when it happens. And it was pretty clear it was going to happen. The stock prices would plummet. The government would finally have to back them if it really got bad, because if you don't have banks, you don't have the financial system. And banks would recover, because if banks don't recover, it means the economy hasn't recovered. Because if the economy recovers, bank will follow suit, because they are the backbone of the economy. You need them for all of the transactions and credit facilities that banks offer that keep economies going. So I figured a major bank has very low risk, but right back then in 2008, the prices just were too high. But I just figured the prices have to decline. We're going to go into a sharp recession, and the banks will suffer. I had absolutely no idea how bad it was going to be, or what a disaster was awaiting us a few months into the future. I knew it would be bad, but I thought this is going to just be a recession. They might lose 30-40% of their value. Never in my wildest dreams did I think a bank like Bank of America would plummet all the way to $2.50. So you could buy it at $4 or $5. It was unreal. Of course, it was very hard to convince other people when it was trading at $4 and $5 that this is a steal. But those that did benefited greatly. Citigroup was an even better example, and I was sorry I didn't buy that one. But yeah, it just seemed self-evident to me that banks created this mess. They were going to, at least the share price was going to be punished for it at some point, but that they would bounce back. And I think even when I was nominating this at the roundtable, we have a monthly meeting where we develop a portfolio based on companies that we like. And for a long time, I was adding Bank of America into that portfolio. I think back then it was at $9 or $10, something like that.
Yeah, we'll actually look at that in a minute. Yeah.
Yeah, it didn't get a lot of support, you know. But for me, it was a no-brainer. Because as I said, if the economy recovers, banks will too. They go hand in glove.
Right. And for those who would like to study a relevant case study, which I think was very guiding, looking with 2020 hindsight in the rearview mirror, if you go back to the early 1990s and look at Wells Fargo and what happened with Wells Fargo, that was a classic case of, the company basically approaching a book value of zero and a stock price of zero. And this mentality of they're not going to let this company disappear. So what, how does it come out on the other side? Ken and I just did a webcast on crossing the chasm, envisioning what the other side of the chasm looks like. And I remember these conversations with you vividly. Remember this one, Hugh?
Yeah. Oh,
I mean,
yeah, that was heady times. I'm sorry I didn't borrow to buy more back then.
Well, I tried. I tried to get a home equity loan and back up the truck, but my wife vetoed that. But again, I think the message that really resonates even yet with me today was this notion of, yeah, this is a look at all the banks, all the financial companies and their return on equity trend going into that really nasty time. It lasted well beyond the actual recession itself. And just
Oh
this
yeah.
notion of, I would ask you, you would keep adding positions to the round table, and it's like, Hugh, what are you imbibing out there? We all want some of what you're having.
Yeah.
And then the response was, well, they might not go back to those 12 and 14% levels that we see here,
hmm
back historically. But what if? What if they climb their way
Yeah.
back to, anywhere in here? Anywhere in here, wouldn't that
hmm
be good? And what would the value look
Yeah.
like then? So, that was
Yeah,
just
that's true.
such a powerful message. So lo and behold, here's what happened to the banks in general in value line. So yeah, I mean the restoration of value, it basically all came to pass. You just had to be willing to envision these banks were not going to go away. They were going to go back somewhere towards those levels they were at. Lo and behold, the forecasts are actually for it to be higher than it was before. I
Mm.
don't believe that. I believe they're going to stabilize out. In fact, they've been trending down a little bit here in recent weeks, just a little bit,
hmm
but not bad.
Yeah.
So
I
anyhow,
think the other lesson from the Great Recession, which wasn't lost on me, was that Ben Bernanke had just assumed a position in the Fed, Princeton professor. And if you look back at history, and one of my drivers for wanting to own a bank was looking at the Great Depression and what happened there, because the Fed did the wrong thing, and to a large extent, you could argue that the Federal Reserve was responsible for the Great Depression, because when the economy went south, they decided to push up interest rates and take money out of the economy. And they reduced the money supply by about a third. And lo and behold, guess what happened? 1/3 of banks folded. And Ben Bernanke, his PhD thesis was on the causes of the Great Depression. Now chairman of the Fed, I believe he would not do the same mistake. He definitely get the printing presses out and flood the economy with money. There's no fear at all that banks will suffer the same fate in this recession as they did, 70, 80 years ago in the Great Depression. And I don't think any chair of the Fed will do that again.
yeah, and as in your opinion, has that carried over to the current situation with the stimulus hunt for
Oh yeah,
solutions?
they want to open the floodgates. I think they've got permission to run the balance sheet up by another $4 trillion, which is just an unreal number.
Yeah.
I'm balking at how this is going to be paid for. But yeah, they can run the balance sheet up by another $4 trillion. They did very well. In fairness to the Fed, they ran their balance sheet up from $800 billion to $4 trillion with quantitative easing, buying various assets. Now they've been selling them back and selling them at a profit, and that profit goes to the Treasury. So they've been doing a good job.
Yep. All right. So Hugh mentioned our roundtable. It's a monthly webcast that we do. We've been doing since July 2010. So you can see that his Bank of America back in October is actually one of the earlier positions in the roundtable. But these are the positions. You can see he went back to the well on Bank of America 5 times between October 2010 and June 2016. By the way, his best of all time was that June 2016 selection.
Yeah.
I mean, at the price of $12, and you can see that it came in at 40.3%, beating the market by 28 percentage points over that time frame. That's just good, clean fun any way around. And you can see, I mean, here's the low price on the Chronicle. This is just a time series. The green are the price bar. The red is basically the return forecast of a stock study, whether it's a stock selection guide or it's just the return forecast, the projected annual return from a stock study. And you can see that was a really neat time to be looking at Bank of America, even though I have to confess that most of us at those webcasts, you were still holding our noses to the banking industry at that point, with the exception of Cy Lynch and Kim Butcher. You can see that there's a number of other financial sector firms on there. And what I'd like the audience to notice is these financial sector firms, asset-based companies, are an area of opportunity. And I mean, only two of the, what is there, probably a dozen market-beating selections there, and only two that didn't. And Cy would basically say that First Niagara just ran out of time. They ran the clock out on them. So yeah.
Yeah.
So
yeah, I think I can understand why most people would have steered clear of banks, because honestly, there was, and I certainly have this instinct as well, that the people behind the banks, and I know the story is a little bit more complicated than you could ever describe it, but basically, someone should have been punished for what happened in 2008. Someone should have been held accountable, and no one really was. I could go as far as to say that there's a flaw in the system somewhere. People can cause a financial meltdown with impunity.
Especially when you look at some of the investment banks and the credit default swaps and things of that ilk. There was some really, I'll just say, weird stuff going on that probably should have been rectified in some way. So now what I'd like to do is take us all back to 2008, the end of 2008, early 2009, and it's actually an infamous time frame. You've heard the stories of Ken and Hugh calling me on the phone, and we're talking about, do we believe the results of our stock selection guides? And this is actually a snapshot of the stocks that were turned in by the community for our annual stock picking contest in early 2009. Okay? Look on the far right hand side, and you will see pars ranging from low 20s up to high 30s. Probably looking at upside downside ratios of 14, 19, 29, just the sort of things that make us kind of queasy. And we were questioning some of this stuff, but again, it's always a good time to buy excellent companies when they are on sale according to the results of our studies, so long as your judgments are sound and feasible and all that kind of stuff. So this was the list of companies. And again, keep in mind, these are chosen by a field of approximately 200 contestants in a stock picking contest in February 2009. These were their consensus selections. And as you look down from top to bottom, bunch of community favorites in there. A couple a little bit off the radar screen, but companies that many of us, the Strikers, Microsofts, Aflacs would regard as, even to this day, very high quality companies. Well, fast forward 10 years to the day, and I left them in the same order: CSS, X, Microsoft, Aflac, Stryker, etc. Going down that list, you're basically looking at a compendium of companies that achieved a 21% annualized return over the succeeding 10 years. Now, one of the things that gives me great joy is I know many of the people in attendance here today, back in that time frame, had a number of these in their personal portfolios and club portfolios. That is just so cool. From top to bottom, really decent reports, really not a big loser in the whole group other than maybe the Next Gen Healthcare. That's the old Quality Systems, QSII. Any thoughts on this, Hugh?
Oh, thought it was muted. No, I think some of those returns are pretty impressive there, aren't they? They look really good. And then there are some positions too that end up getting sold off, so they wouldn't be reported here, are they?
No, that's all of them are there. There were a couple that were. Buffalo Wild Wings was acquired, but at a huge gain.
Yeah. Oh, right. There we go. Sorry, I didn't see that at the bottom. Yeah.
But the rest of them, and there was one investment club that really was a great fan of Louis Navalier, and that was taken private, the particular but with most part, those are pretty solid top to bottom, and many of those are still part of core portfolios to this day.
Yeah, I'm sorry I didn't buy more Microsoft and Aflac back then.
Yeah, I can remember the debates over Microsoft back in that time frame very well.
Yeah.
And you may remember Aflac had trouble with Greece and some of the fixed income investing that they were doing back in that time frame, and subsequently, companies do face challenges during their lifetimes. Just have to, as Cy Lynch would say, you have to decide whether it's temporary or terminal. All right.
Yeah, that's a good point.
So again, here's a look at the current day stock market. This is a graph that we put out all the time. This is the companies in the value line standard edition. Basically the average price of those companies is reflected by the green price bars representing the market at the bottom. The blue line is the just simple regression or mathematical trend through those green price bars, and I think it is very telling when you look at the appearance of that. One of the things that I find interesting, again, go back 10 years to this really nasty time 10 years ago, and look at the chasm that Hugh was thinking about buying a bank in, back in this time frame. Yeah, it was a nasty moment, one of the worst in stock market history. Back in that time frame, though, factoring in the fundamentals of the companies in question, that slide that you just saw, look where the return forecasts were. Up in the 20s in general. So again, I think having this at our fingertips and our awareness in the context of knowing what a stack of stock selection guides look like actually helps people who know how to do this stuff maintain their sanity through periods like this. And we just had it again, just very recently. Notice that the price on the average stock study, the average return, actually approached those levels from 10 years ago, and we're in the middle of another one of these white spots or chasms right now. I have no idea what it's going to look like going forward. Hugh, do you know when this all is going to end and at what levels?
I'm afraid I don't.
on a Tuesday, right? Tuesday is a good day for that.
Yeah, I do. It's going to mirror what's happened in the past. It always does. There's always an echo in the market. It's not a perfect resonance, but it's very similar to what has occurred before. So it will bounce back because people aren't going to change, and people are the thing that drives the economy.
Yeah, so have faith, get out there and pick up opportunities. The one thing I will notice how sharp that snapback, it's almost like a rubber band. I was on the phone with Kim Butcher a few weeks ago now, looking at a stock that I was interested in that was trading at $24. I went up and microwaved myself a Costco hot dog for lunch, came back down, and the stock price had gone up to 34 in that amount of time. So, sometimes those opportunities, like I say, they're frustratingly fleeting in this market. All right, so with that, we'll just kind of close down with a summary. Stick to the foundations. Understand what these decades have taught us. Trust your studies. Do them carefully. Form your judgments carefully. But again, I think that the manual, as shown up at the top of this page, really captures the spirit of how investors should think long term. Nicholson said that you ought to be able to make a judgment on a company pretty quickly. He might actually boil that down to a few less minutes with the tools that we have at our disposal versus him and his slide rule a few years ago. What thoughts would you share with the audience in this regard, Hugh? Uh-oh, muted again.
Sorry, I was muted. I love this book. It was one of the first ones I ever read. But yeah, it's really, if you can take emotion out of investing, and it's hard to do, we all find that difficult to do, but if you can do it and look at the big picture, I think it's going to solve an awful lot of problems, right?
Yeah, it's so
hard.
hard.
The 10-minute analysis, you do have to be able to explain what the company is, because in short, brief moments, as if you were talking to your grandmother, accurately as well.
Mm-hmm. All right, so with that, we'll invite the audience. We'll be able to take some questions. Ken, I think we're doing all right on time, right? Ken Cavul is definitely muted if he's still with us.
Yeah, he's probably muted, chatting away there.
Either that or he snuck away for his field research into adult beverages this afternoon.
Yes.
We do.
I was just nicely chatting away. You're absolutely right. Okay.
It's the best conversation we ever had.
You have about 10 minutes yet to answer questions. Let me start you off with one that just came in, okay? And I got to bring it so I can read it. Here we go. This is from Dave, okay? And he says, with 36 million people applying for unemployment, states, counties, and cities are running deficits, and there's little prospect for a quick rebound. My question is, how do we project earnings over the next few quarters, years on our SSGs?
All right, Hugh, I'll let you tackle it first, and then I can chime in.
Yeah, I mean, the underlying statement here is one of how bad the economy is. It's not being pessimistic, it's been realistic, right? That things are bad. Local government will have to borrow to meet its financial obligations. Things are bad, and it looks like the economy is going to slow down, which it probably will, right? We've had a 10+ year expansion. It always by definition has to end in some kind of contraction, and we're probably in the middle of that right now. People might even call it a depression, but I don't think it's going to be dramatically long-lived. It might take a while to claw back to where we were. I thought initially it might take a year, it could take 2 years. But in terms of projecting what's going to happen, I wouldn't be overly pessimistic myself, but that's probably part of that is my nature, but I wouldn't be overly pessimistic about how things will bounce back. I don't think it'll be a quick rebound. I'm now assuming it's going to be maybe 2 years for things to get back to normal, or somewhat close to normal.
Personally,
it all depends on this virus, right?
Yeah. Well, Hugh, you're one of the people uniquely empowered to respond to both sides of the question. I mean, Dr. Fauci's only doing one side, and Mnuchin's only doing one side. I think they could give send those guys both on vacation and replace them both with you.
Yeah,
see the
there's even a lot more uncertainty with the virus because you just don't know what's going to happen. Will it burn itself out like many viruses have done in the past? Will it come back with a mutation that's even worse? Which that's a kind of a low probability event, but it could occur.
Okay, and now for my serious answer, we are actually tracking very, very carefully. In fact, Ken, I think we'll go ahead and shut down for the rest of the Q&A section as far as the recording's going. And that'll enable me to answer the question a little bit better. But thanks, everybody, and hopefully we'll see you tomorrow at the final 2 sessions of the COVID cancellation conference. And thanks, Hugh. Really appreciate your thoughts on this stuff.
Okay, thank you.